Hey guys, welcome to another Trade Genius podcast. Bob and Phil here, as always. Guys, what if I told you that in reality, the Fed only just started raising rates? Will they continue? We'll have to discuss that. But this is probably why we've avoided a recession up to this point. If you don't believe me, you're going to want to watch this video. Let's dive in.
Trade Genius.
Yeah, Phil, I think people look at the wrong information here all the time. And we really now, I think we're going to be caught in a vice because we went from way too loose policy. If you look at this Fed funds rate minus the CPI, we went from being way too loose to now the Fed funds rate is actually tighter than the nominal CPI, but CPI is going to creep up again too.
Right.
So I think the Fed's like, now what do we do? So if they do nothing, we're already starting to see people anticipate the pause, right? The market's starting to wiggle. Oil's going up, precious metals are going up, commodities are going up. If the Fed decides to raise rates again, then I think they bring everything down. So I think all of their maneuvering room has now have been I think wiped out. So it's going to be really interesting to see. And if we go to the next chart, you can see the we're already rolling over. And if you look at the gross domestic income, which GDP will go down to the income, they can't be separated for long.
No.
And a lot of that has to do with inventory, Phil, and trade flows. So if income's falling, GDP is going to fall.
Right.
So now you have GDP falling below a higher CPI rate.
Right.
And my opinion on this, we never left a recession. And I know people say we're going into recession. We've been in one for the last year if you count CPI over GDP. And this is going to actually exacerbate it.
Yeah, these things should be moving in tandem, GDP and GDI, and I would argue that GDI is much more important here. GDP gets thrown out there a lot. It's, the Hollywood number that everybody looks at. It's what you're going to hear about on CNBC and these other outlets. But really, GDI, which nobody really talks about, is the real number that you want to keep an eye on. And when you get these alligator jaws, right, we show you a lot of charts because there's a lot of things that are decoupled here. And there's reasons for that too, because ultimately at the end of the day, we've been dealing with is a stealth QE, which, if the Fed or the Treasury is putting money to work in the economy, you're going to get an elevated GDP. However, that can be disconnected from GDI, which is gross domestic income, which is really what's important here, and I think is your early warning system for what will be an official recession. And I agree with Bob. I think that technically we've probably already been in one. We see enough feedback from people that things have slowed down quite a bit in different locales across the country. So if these jaws are going to close, we should see a drop in GDP going into next year, Q1, Q2. And the other thing too, Bob, is this other chart, which I think is very glaring. So if you look at, now we're just talking macro here, right? We're going to have our ups and downs and our wiggles, but we're talking macro here, rolling over into next year. Never have we had a bull market start where the banking index, this is the KBW bank index, right? This is making lower lows while the market is making higher lows and higher highs. Hey guys, if you guys don't mind, head over to tradegenius.co. Check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So, this is a big warning sign. I don't think enough people are looking at this. It's certainly not being talked about that much online, in my opinion, but I think it's a huge warning sign, and people are going to be like, after the fact, going, oh yeah, this is why we rolled over on the S&P 500. We caught down to the banking index. You're just seeing an unprecedented divergence here between these two indices.
Yeah, I mean, look, I don't even argue with people anymore. We're not in a bull market. So the debt-based system banks for everything. And the banks have expensive deposits now, and they have a loan book that's at risk. I don't know about you. I didn't get an MBA in banking, but that probably is not a really good sign for the health of banks and help of lending. And we're going into next week a potential government shutdown again. The Republicans are not going to give Biden the pass they gave him. They're not going to give him a continuing resolution, that's for sure. They're not going to give him a slush fund to go into the next election season. So some of this money's going away too. So all the liquidity pools are being closed, Phil. The spigots are being turned off. And and we're gonna see walnuts here being cracked in a vice here, because I don't see how people get out of it. There's really no way out at this point. It's just a matter of when is it the recognition event's gonna come.
Yeah, and I think today's Friday. We warned you guys about OPEX and the volatility going into that, and the potential for a drop into OPEX or after OPEX. And today's a good example of how volatile things can get. We had a quick 60-point drop in the S&P 500. That's roughly about 600 points in the Dow. And I think you're going to have to get used to this volatility. Now, that being said, what's driving this market still is like things like the reverse repo window, which Yellen keeps giving them these short-dated treasury bills to basically turn into collateral for the market. So I do think we're going to have a period where we kind of bounce around in range here. But as we get the closer we get towards October, and I think mid-October, you are getting more and more dangerous as far as the ability for this market to stay up at these levels. So we'll have to see what the market reaction. I am in the camp that if the bears don't get it done, meaning that they don't drop the market fast enough and deep enough, that you're going to start getting another round of OPEX flows into October or OPEX flows in November that kind of come in and save the day. That's just how this market works. What prevents that from happening is you get a severe enough drop where you punk all of the hedging flows, and now they're chasing it lower. And that's when you're going to get into a situation that we saw in the first part of 2022, where we had extremely volatile days, and the market ultimately was seeking out lows into the middle of the year in 2022 with a final divergent low into Q4. I think there's a lot of similarities building up for us into 2024 in that regard. So we'll have to see how it goes. But I think the macro, essentially, Bob, the macro will ultimately start controlling these hedging flows that are so powerful in this market. And ultimately, that's what's going to lead us lower into next year.
So, Phil, yeah, we were going to do a video, but what if we were wrong? But I don't think we're wrong. So we're going to postpone that.
Yeah. All right. Well, in tomorrow's video, we're going to cover some crypto. We haven't touched on that in a while, because where does crypto and Bitcoin fall into all of this? So we're going to talk about that tomorrow. Guys, let us know what you think on the information presented here today. We'd love to hear your feedback below. And as always, please hit like and subscribe. Check out our specials over at tradegenius.co. Love to see you in the room, help you navigate these markets day to day. We'll see you on the next video. Take care.
Trade Genius.